Johnson & Johnson is on the safer side of investments that long-term buyers can look out for. The company's business doesn't rely significantly on macroeconomics. Things like unemployment and GDP growth doesn't really matter all that much to a company like Johnson & Johnson as it does with other more cyclically sensitive businesses. So if you're afraid of a recession or an economic slowdown, Johnson & Johnson can be a great stock for you. But what's a fair price to pay for this business? That's what I'm going to do in this video is calculate a discounted cash flow valuation for Johnson & Johnson stock for those of you that might be interested in this defensive play. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so there are three primary sections to this discounted cash flow model. The section highlighted in green, the section highlighted in blue, and the section highlighted in red. The starting point is the green section where we'll evaluate the forecasted free cash flows the company expects to generate throughout the life of the business. So the analysts on Wall Street that are following Johnson & Johnson, they expect the company will deliver $21 billion in free cash flow in 2025, and that will increase to $28.7 billion in 2029. Between 2029 and 2035, I forecasted free cash flows for Johnson & Johnson to grow at a rate of 6%. So $28.7 billion rising to $38.4 billion by 2034. That's a rate of roughly 6% compounded annually between those years. Now, between 2035 and the longer run, I'm forecasting its free cash flow will slow down even further to 5%. And so instead of forecasting each one of those individual cash flows between 2035 and infinity, I'm going to conduct a terminal value calculation here that suggests that this business could generate $1.5 trillion in value in those years, $1.5 trillion in free cash flow between 2035 and infinity when I take the present value of those free cash flows. And the key to the reason why that terminal value is so large for J&J is the very low discount rate. Remember at the beginning of the video how I highlighted the business is not very cyclical. It doesn't depend on macroeconomic growth. And so for that reason, it earns a lower discount rate because it's lower risk. And all else being equal, investors prefer a business with lower risk. If we're going to invest in a business with higher risk, we want to be compensated with a greater return. And so our discount rate is higher for businesses that are higher risk. That's the key, right? That's the risk versus reward calculation. I go through that every year at the university when I teach this topic. I talk about that discount rate and how it's important not to take uncompensated risk. It's not that as investors we're afraid of risk, right? We don't shy away from risk. But what we want is to be compensated for risk. We don't want to take risk just for the sake of taking risk, right? We're willing to take a risk if we're getting paid to take that risk. Just like an insurance company doesn't give out its risk for no reason, right? It doesn't insure people and companies and homes and cars for nothing, right? It's willing to take the risk for the compensation that people pay every month in their insurance premiums. And so just like that, we want to be compensated for the risk that we're taking. That's why we discount these cash flows. So when we get to the present value of all of those free cash flows, that totals $933 billion for J&J. So the weighted average cost of capital now, I've calculated a weighted average cost of capital of 7.6%. I've given them a cost of debt of 7.5%, given their lower risk business and very strong free cash flow, and a cost of equity of 7.6%, given that their beta is only 0.52. That's very low, right? When you're looking at me evaluating companies 0.52 is the lower end of any of the companies you'll see on these discounted cash flow models. And this measures the company's stock price action in relation to the stock price action of the S&P 500. 0.52 means that J&J's stock price moves at about half the percentage points as the S&P 500. So when the S&P 500 goes up by 1%, J&J only goes up by 0.52%. And the same on the downside. When it goes down by 1%, J&J only goes down by 0.52%. So less volatile, right? And that's what you measure risk with, is volatility. The risk-free rate, 4.5%, 10-year government bond yield. This is about what it's rating right now. This is about what it's yielding right now, I should say. And the market risk premium of 6%. Since they have a market cap of $366 billion and total debt of $36 billion, I've given them a target capital structure of 20% debt and 80% equity. So I've combined all of that to arrive at the weighted average cost of capital of 7.6%. All right, now we can go to the red section where we start with the value of operations we got from the free cash flow section of $933 billion. We need to add the company's cash balance to that total, and we need to subtract the debt balance. Then we get to the value of equity of $917.682 billion. But we want to know the price per share. So we got to divide by the number of shares outstanding of 2.4279 billion. And that brings us to the intrinsic value per share of $377.97 compared to the current market price of $153. So with a large margin of safety, the company's share prices are right now undervalued compared to the intrinsic value that I've calculated. For transparency reasons, the numbers you see highlighted in blue, I've retrieved from Yahoo Finance, and the numbers you see shaded in green for the free cash flow, I've taken from ticker.com, TIKR.com. So to answer the question I posed in the headline, what's a fair price to pay for J&J stock? Well, anything below $377 is a fair price to pay for Johnson & Johnson stock, and thankfully you can get it today at a much lower price than the intrinsic value, or thankfully for myself, because these are calculations for myself personally. So I've got this stock on my list of potential buys because of the wide disparity in the current market price versus my calculation of its intrinsic value. So I'll be doing more research on Johnson & Johnson to potentially consider this as an investment. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.